So let's look at the KPI chart for this company. This is a restoration company that does about 12 million in revenue a year. Has about 41, I think, employees. So let's look at our month compared to last month. So our total new jobs, 127. We're down 10 from last month. I know that February was a banner month. There was a big ice storm. So the fact that we're down a bit is not concerning. The average job value is down a bit, and that actually can make a big impact to our profit. So we'll keep an eye on that. Although I think that's also back to more what is their normal for this client. So our mitigation jobs compared to last month, that all seems pretty proportional and reasonable. The average job value for the different types. Our recon jobs are down a bit. Our labor percentage is up quite a lot, which it's still under 30. So conceptually, that might be just fine, but we definitely want to look into what caused that rise, whether it was a change in the mix of in-house employees versus subs. It's okay often if the labor percentage rises if the mix changes and it's more sub labor, because while their labor is going to show up probably up in your COGS, they're actually dealing with their own expenses. They're dealing with their own vehicles, their own insurance, things like that, their own uniforms probably, things that you don't actually have to then factor into expense. So while this number went up and while your COGS percentage might have gone up when you've used more subcontracted labor, potentially you'll get a savings in the expense side. So it may be fine. The fact that it's still under 30, I feel pretty comfortable with that, but I'll definitely be asking them some questions to check into that further. Our COGS percentage being at 44% is higher than we'd like to see. Ideally, we would want 40% or lower, but it depends on the product mix and the client. But this is a little high and it's creeping up a bit. So we definitely want to keep an eye on that. Marketing percentage, 5 and 6%. Both of those seem just fine to me as long as we're getting return. And that's a matter of measuring where the marketing effort's going through and whether that category is rising and you're getting return on that marketing. Our overhead percentage is up. I think that that's primarily because they had so much revenue in February. It's still under 40, so I'm still pretty comfortable with that because I think it was just their big revenue bump in February that is made this rise. I think this is actually more their standard. So I'm not too worried about that. Profitability. So their total revenue is down, but I think this is down to approximately their usual. So I'm not going to worry about that just by itself. Gross profit margin, I'd love for these to be above 60. Operating profit margin, I'd love for these to be above 21 or so. So we are okay so that our net profit can stay at least at 20. So last month was a phenomenal month. This month being at 20, it's all right. Our break-even margin of safety looks fine. Of course, we'd rather have more cash, but we don't always have ice storms. So there's not always much we can do about that. Our cash flow drivers. So our debt to equity ratio is staying similar. That should be okay. Our sale or purchase of assets, very little is happening here for the size of the business, so that's fine. Our loan repayments are staying stable. Our owner is not taking money out or putting money in. It's great that they're not having to put money in because there is cash in the bank. So here, we ended up with some cash flow issues this month. Primarily, they were profitable on paper, so that wasn't the issue. Primarily, it was because they aggressively paid down their bills, which is fine and a good thing in some ways. Now they have fewer bills owed, but a lot of cash went out the door. And then when you add on top of that, the fact that the AR increased as well. So the combo of that put us about $140,000 short, shorter on cash in the bank than we were at the end of the previous month. There was some cushion, so it'll probably be okay, but we just want to keep an eye on that trend. So operating cash flow, free and net, are going to be very similar because in restoration businesses in general, we don't do that much as far as investing activity where it would bring in cash. And we don't do much financing activities. So for the most part, your operating cash flow, that's the money going in and out from business operations. And so that will be the one we look at the most closely. If we are unprofitable and we are trending across months being unprofitable, when our operating cash flow goes down, that's really concerning because it's a much harder fix. In this case, it was because of AP and AR changes. AP changes are pretty easy to make. Probably they can just pay bills a little bit slower if they can get away with that, and that might fix that. It's at least sort of under your operational control. AR, we need to get collections flowing faster. That's more complicated, but certainly at least there's a concrete action to go work on to get that moving along. So those reasons are less concerning than when we're losing cash because we're unprofitable. It's an easier and more correctable fix, hopefully. Cash on hand is down significantly from the end of February to the end of March, which is what we knew we would be seeing because we know that the operating cash flow is down. So this is kind of just saying this in a few different ways. Our net variable cash flow is down a bit as well. Okay, so our activity. So our accounts receivable days are really up. We definitely want to get that under control. 67 isn't ideal, but it's more in the range of we don't like it, but it happens sometimes. 99 days is really high. There's probably a lot of reconstruction, large, long reconstruction projects, not problems directly, that will then become AR problems if we don't keep an eye on it. So we want to look into what we can do to reduce that. Our accounts payable days is nice and high. So that part I'm not concerned about. It's great that it's that high. We want our accounts payable days as high as possible. Our cash conversion cycle, 27 days. Let's see here. So liquidity. So our current ratio is great. We want that to be above 2-to-1, and over 4-to-1 is fantastic. Operating cash flow to current liabilities. Our operating cash flow is down, so this is going to be a negative number. So we're not delighted by that, but we could have seen it coming for sure. Our return on equity is great. Return on assets is great. Our revenue per admin, I'd like to see it a little higher. Last month when we had more work, they were handling more jobs. And if I recall correctly, I think they handled them pretty well. So their capacity probably is a little bit higher per admin. The revenue per tech, I know that these techs were pretty tired and stressed last month. The revenue per tech is probably back to about what is appropriate, where we aren't having to add overtime or temp labor or things like that. It depends a bit company to company also. Job acquisition cost was up a tiny bit, but it's up a little bit, and our job size is down this month. So I don't love that combo, but we'll keep an eye on it. It'll probably sort out. It's not massively concerning. So our growth, our return on assets for the month is good. Our revenue growth is down, but last month we had a huge month, so that's okay. Our gross profit growth is down, net income growth is down, but we would expect that. The previous month we had huge gains. So when we have a better history, a longer history with this client, we'll be able to expand and do it quarter over quarter or year over year, and that's going to give us better info. AR growth rate. So our AR is growing, which if it's growing because we have more revenue, that part of the AR growth is great, or it's unavoidable. It's for good reasons. The part of it that is just from our collections getting slower, that part we don't love. So ideally, we want revenue going up and our AR going down, because that means we are collecting faster than ever, which is a great thing. Our job value growth rate is down. This is the fact that the average dollar per job was down this month. So we need to look into that and see if there's anything we can do to boost that back up a bit. Revenue growth rate here is down because we had fewer sales because we weren't having ice disasters. Our AR growth versus revenue growth is down, and that is fine. So that's basically where we're at. This is, we use this for different purposes for our benchmarking, our free benchmarking program. So that is where we are at for this month with these folks. If we can help you out and help you keep an eye on cash flow issues, profitability issues, help keep an eye on your numbers and get the right visibility into your numbers, and then ask the right questions so that we can be successful and your business can grow, we would love to help. So you can find us at kiwicashflow.com.